I'm Charlotte McLeod with investingnews.com, and here today with me is Dana Samuelson, President of American Gold Exchange. Thank you so much for being here. Great to have you.
Hi, Charlotte. It's great to be back. Great to see you.
Really good to be catching up with you. I went looking back. It's actually only been a few months since we last spoke. It was in March. But everything is a little bit different at this point,
Oh, yeah.
So lots to go over. At that time, I think we were talking about 3,300 to 3,500 gold, which of course we got just to that 3,500 level. We pulled back a little bit now, but I'm wondering, do you have an updated gold price outlook for the year?
I think it's possible for us to see gold close to 4,000, if not at 4,000 this year. We made a big move in the last 15 months, up from 2,100 to 3,300 basically today. What's hard to figure out is gold tends to make big moves and can go sideways for a long time thereafter. But I do think that the drivers that are pushing this market are still in place. Some of the uncertainties come out of the market with the tariffs are now being actually announced as we speak. We're getting new announcements every day. So some certainties coming back to the market, and the instability that hit in April in particular when the reciprocal tariffs were first announced has passed. The equities markets are all back up to highs, and there's complacency again. So gold tends to climb a wall of worry, and there's a little bit less to worry about right now. But I don't think what the things we have to worry about are over is the point. So
I think that's a nice summary. It is tricky to be doing this conversation now, especially the tariff talk week. So we'll see how those things develop. But you mentioned, okay, the drivers for gold are in place. Many of these are not going anywhere. What would you pull out as, say, your top driver of gold right now?
Right now, I think it's the weaker dollar. The dollar has down about 11% to 12% since January. And I do think that we could see further dollar weakness, which would help to underpin gold and drive it higher. My biggest concern right now is that in April, when gold went from just under 3,000 to 3,500 on some very specific tariff uncertainty with China. Well, it was tariff certainty, and I can get into that in a minute. We did see, for the first time in my career, in earnest, a phase where the dollar and U.S. treasuries were not first choice safe haven. Gold became first choice safe haven, stepped in front of them. And it makes me wonder whether our treasuries are going to lose allure internationally because we need foreign investment money to help support our debt. And we have $18 trillion worth of debt that we need to refinance this year and next year. And Scott Bessent wants the interest rates to be lower. Well, why would you want to invest 5, 10 years or longer in U.S. treasuries when you're going to get a lower rate and a weaker dollar, especially if you're a foreigner? Because if you earn a 5% treasury yield, for round numbers, and the dollar drops 10% like it's done in the last 6 months, and you repatriate that money, well, now you're down 5%. So the incentive for foreign investment in our treasury market, which has helped to underpin it, is waning, especially in a weaker dollar environment. Plus, the tariffs are being handled in such a bit of an erratic manner. It's creating a lot of uncertainty, but it's also, I think, a bit bullying, which puts people off. Now, a lot of our trading partners don't have a choice in the short term, but because they're dealing with necessity. We've got to figure out a way to deal with our biggest customer, which the U.S. usually is. But then once you've done that, you've decided, okay, where else can I go so I'm not as dependent upon my single biggest customer so I can spread it out a little bit. No business likes to have one entity that they're majority relying on, because if something happens to that entity, then you've got a big problem with your business. And I think we're making a lot of the world think about trading with us in those terms right now, and I'm not confident that that's going to engender a lot of trust or renewed investment in the U.S. from around the globe going forward.
Yeah, that sounds like it's a massive problem building.
It has big potential, negative potential for the U.S., but good potential for gold in the long run.
Right, so that puts that 4,000 possible price into some good context.
Yeah, and that if this plays out the way it could, I'm not saying it will, but it could, that gold could be substantially higher than that in the long run.
we will certainly be keeping an eye on what's happening there. And so you also mentioned the weak US dollar, and I want to go into that a little bit as well. I think I was reading headlines saying it's the worst first half of the year since something like 1973.
Correct.
And I think you mentioned that also in your presentation yesterday. So what is your outlook for the dollar, and why, what's behind that's a significant time period?
Well, we've seen two big legs down in the dollar this year. The first one happened immediately after President Trump and Volodymyr Zelensky had the blow up in the White House, where President Trump said we would defend the Ukraine on a lower level than we have been, which meant that Europe had to pick up the slack to keep Ukraine defended against Russian invasion. And that meant stimulus spending in Europe that they hadn't contemplated before. So less spending in the US, stimulus, more in Europe. Some of that money that was European money left the US to go back home because better opportunity. That took the dollar down one leg. And then when we had the reciprocal tariffs announced, the dollar got a little bit of a bump, but then there was another wave of foreign money that left our markets in the big liquidity event and left the country. And that was reflected in a weaker dollar. So now I think we're heading into an economic slowdown, not a fall off the cliff recession, but an erosion of economic activity, a steady decline due to uncertainty over how businesses are going to react to these tariffs. I'll give you an example or two in a minute from what I've just heard at the conference we're at here. But I think the Fed will be forced to lower rates, and Trump wants lower rates. He's announced that, and we're going to get them one way or the other in the next year once Powell is replaced with whoever President Trump picks, because whoever he picks will make sure the rates are lower, but we might get him in the meantime. And I think that'll weaken the dollar further, and there's better tailwinds outside of the US for investment when you have a weaker dollar phase that we're in. And if you look at a 25-year dollar chart, and I do a lot with charts, there's three different trading sectors the dollar's been in over the last 25 years. We have been in the higher trading range for the last couple of years. Now we're in the middle trading range, but at the high end of it. So I think we could come down more towards the middle or the lower end of that trading range. And if we break that support, we could go into the lower third trading range that we've been in, which is really weak, which is where we were during the great financial crisis. And that could, give an even bigger boost to gold. But the dollar's already down 12%. It could go down another 3 or 4 or 5% this year pretty easily, I think, just through economic activity alone. But some of what I've heard here at the conference, one customer came to our booth and said that he has a friend who imports pepper. Okay. Pepper, because we don't make pepper in the US. Well, who's his customer? Walmart. Oh, they need a lot of pepper. A lot of pepper. But he doesn't know what he's going to pay for it. Right. He doesn't know. So how can he order? How can he price? And they want the lowest price they can get, of course. So he's caught between a rock and a hard place. He doesn't know what to do. And this is one person, one small business, and this is all over the entire importing spectrum right now until there's clarity. And even when we get clarity, we're not sure it's really clarity, because we just punted the deadline for tariffs back another month, and some things are still being negotiated. So I think there'll be tariff uncertainty to persist for the rest of the year until we really get to the goal line, which maybe won't be the goal line,
Yeah, it feels like that. It definitely feels accurate the way you're describing it. And just a side note, I think it's interesting to see how the tariff conversation is changing. I remember when we talked in March, we were speaking about, and you explained very well, the flows of gold and silver into North America because of the tariff threat there. And now it's a whole different set of issues that we're looking at. But so going to the Fed, I think they've said, all right, if we didn't have the tariff concerns, we would have lowered rates already. So what do you make of that? You talked a little bit about what you see from the Fed moving forward, whether we get those cuts or not. Anything you would add?
I think it's possible we'll get, the market's anticipating a 1 quarter point cut this year. I don't think the Fed is going to be that materially relevant this year, right, because we might get a quarter point, maybe a half point. But in the beginning of the year, I realized that President Trump, we did a video where the thumbnail was Trump and Powell having a fist fight. And it's like, who's going to be dominant this year? And my thought was, it's going to be Trump. And that's how it's been. And I think that's the way it's going to remain for the rest of the year. So I don't think, unless the Fed is forced to really drastically cut, they're not going to have much big of an influence in the markets this year.
Yeah. Okay, good to
Yeah.
know. So I think that gives us some good context on what's going on in gold. But I have to ask you about silver as well. And when we last spoke, you called it the metal of opportunity. And since then, we have seen the price on the rise. I think when people are looking at this, I've been describing it as some cautious optimism, because people want to see silver follow gold, but there's the volatility angle and people aren't sure if it's going to stick. So what are your updated thoughts on silver?
Well, silver is in a classic technical breakout. Over $35, which is holding now, is a 13-year new high, right? It's testing second resistance at 37. There's actually a $2 window between 35 and 37 for round numbers, where silver traded on the way down in 2012, 2013. Over 35 is good, but over 37 is really better, because the next higher resistance point is 44 in a round number, 43 and change. So I think that is the next trading level we're heading to. I don't think it'll be a straight run. I call this a grinding market. It's 2 steps forward, 1 step back, but it's stair-stepping higher along the way. So when you get that step back, that's your chance to buy in this market. And the chart is pretty solidly up, but it's volatile. Like you said, it's got a lot of volatility. So picking your entry point or your exit point if you're a trader is pretty critical right now, because you're not quite sure what's going to happen next, especially with this knee-jerky news cycle that we're living in, governing by presidential tweet.
By tweet, yes. By Truth Social.
By X,
yeah. Or whatever it is, whatever the correct names are now. Okay, so that's what's going on with silver. So this is a little bit tricky, if you looked toward the end of the year, where would you see the silver price?
Well, like I said, gold could go sideways. When the gold to silver ratio went over 100 to 1 about a month and a half back now, I guess, I think it made people who have been in gold say, look, there's opportunity in silver because it's so underpriced relative to gold, but there's also opportunity in platinum and palladium. Yeah. So we've seen, and that was when gold had peaked and then was coming off a bit after President Trump signaled that, hey, we could ease on China a bit, but before we really got into the real nitty-gritty of lowering what was then 154% tariff against them and 124% tariff against us. They wanted to stay in the metals sector, but they wanted to find opportunity in other metals. So they rotated into silver, platinum, and palladium. And we've seen both platinum and palladium make some pretty good surges too. So I think that caused a shift within the sector, which is now it's benefited platinum a lot. Platinum's gone up 45% in 11 weeks, which is a huge gain. If you look at ETF flows, the Chinese bought more gold in ETFs in April due to tariff turmoil by 4-fold than they had bought on the 3 previous high ETF flows in 2023 and 2024. So the reciprocal tariffs that we took off of everybody else but ratcheted up on China at the same time spooked the Chinese, and they bought gold like crazy. They also bought platinum in earnest, which I didn't realize at the time, but there's been an article that came out of Bloomberg that said in April the Chinese imported 370,000 ounces of platinum. The NYMEX holds 350,000 ounces of deliverable platinum in registered and available sectors. So in 1 month, they took in more physical platinum than the entire NYMEX had for delivery, which popped the price. I think the opportunity still is in silver, but I also like palladium as kind of a sleeper right now because it's lagging a couple $100 behind platinum, and it's scarcer. But you can't use palladium in jewelry, but you can use platinum in jewelry, and platinum is making a jewelry substitute for gold in Asia, primarily in China. So that is part of the allure for platinum, but I think there's more that's going on under the hood that I haven't quite figured out yet with regard to that.
It's a tricky one, and I'm also trying to wrap my head around what's going on with platinum and what are the drivers of this move. So,
So I think we could see silver, $42 to $44 before the year's out. Right, back to your question.
Yes.
Platinum is hit over 1,400, and it's channeling about 1,350 now. I think you can get into the $1,500 range. I do think palladium is cheap at 1,150 or thereabouts. I think it should be 1,300 or 1,400, close to on par with platinum, because it's actually scarcer and used in automobile catalytic converters, and gasoline engines aren't going anywhere anytime soon. So.
The other point I wanted to ask you about when it comes to all those precious metals is trends that you're seeing among your customers, your buyers. So I think we've talked before, and even a little bit right now, about the Asian demand and how this is an Eastern-driven market. What are we seeing in the West?
Well, you're entirely correct. This is a global, international gold market. It's not a U.S.-centric market. And the classic U.S. drivers are not really in place like they have been. It's mostly central bank buying, which is increasing still. So in the U.S., what do we have? We have the highest gold price we've ever had. We have some complacency because the equities markets have rebounded and set new highs in some regard relative to where they were prior to Liberation Day. The economy's still kind of okay, but it's weakening. And there's no fear, which is a big driver. But we've had inflation's bite have a cumulative effect for the last couple of years, which has undercut the middle and lower class. So we're seeing distressed sellers to a degree in precious metals. We're getting more selling in gold than we're getting in buying by the retail public in the US. And it's not from first tier owners. A lot of this is inherited metal that, the people that got it from their parents, they need the cash or they want the cash for whatever reason. They're dishoarding. So we're seeing some of that, and we are seeing some genuine distress selling. We are seeing some genuine profit taking from people that had it, for a long time. But I don't think this metal market is over by any way, shape, or form. We saw kind of a similar wave when COVID hit, and you wouldn't think about that, but gold hit $2,000 an ounce. It was a trigger point. And now gold's over $3,000 an ounce. It's another round kind of trigger point. So the retail investor in the U.S. is not fear-driven at this point in time for precious metals, and that's really the primary driver. We've got a little bit of a wave of it when we saw all the turmoil in April and the markets tanked for a couple weeks, but that was a kind of a modest wave, but that was really the only buying surge we've seen this year. And until there's a bit more to be worried about right in front of us, I don't think the U.S. investor on average will be in the market. Now we've got some big money clients that are buying. They get it, right? The smart money is going where it needs to go. But on average, the average retail investor is not in participating in this market the way you might think they would be.
Very interesting. I'll come back and ask you about that later as well. We can follow up on what goes on there. At this conference, at the Rural Symposium, I've noticed, so you're out there, you have gold and silver that you have available. Other companies are also having products available for people. And what I notice people asking is, all right, what should I buy when I'm looking at the physical metal? What's the best deal? Where is the most, maybe not the most opportunity, but people are, I think, curious to know that. So any thoughts on that note?
Well, we do a lot more of our business in gold and silver than platinum and palladium. Yeah. And I've already given you my thoughts on, especially on palladium. I think silver is clearly the better opportunistic metal for price appreciation right now. Just it's got more potential in the short term to go up 10, 20, 30% than gold does from here. So we're leaning into that. But with silver, you get a lot bigger, bulkier storage issue than you do with gold. And gold is leading. So we like both of them. If you're a new investor, I say go 50-50. If you've got a position established and you want to add, I think silver is the better add at this point in time. And that's what we're telling the people that ask us.
That makes a lot of sense. Okay, we have gone through a lot of different topics, but are there any final thoughts you would want to leave investors with in these very interesting times?
Well, we're in a real conflict with the Chinese at this point in time. And when we took the reciprocal tariffs off of everyone else, we ratcheted them up on China. And we put them from 34% up to 154% while we told everyone else you can wait 90 days. And that really spooked the Chinese. When you tell your best customer, we're going to pose tariffs of 154%. What we're really telling you is we don't want your products. But I don't think most Americans get that. When I ask you or anyone else, what does 154% tariff on China mean? Everybody says the same thing. Well, things are going to cost more. But if you're an Asian producer of goods, it means my client, my best client, doesn't want my product. What am I going to do? And I really think we're setting a precedent for years to come. That, hey, maybe the U.S., you can't trust us as much as you have in the past in basic business. I really admire President Trump for what he's trying to accomplish, because we have some big problems, our debt and our deficits. And the tariffs are designed to reduce the deficit and hopefully reduce the debt in the long run, the debt to GDP ratio in particular. But I don't like the way we're going about it. Yeah. It's erratic, it's bullying. When you poke somebody in the eye, they close that one eye and then they look around for, where do I need to look next? And I think that that's what we're causing, the world to do. And I'm afraid that this is going to take us down about a half a step in stature around the world. And that bothers me. I hope we can accomplish what President Trump's trying to accomplish. And he has some tangible accomplishments to sell the electorate before the midterms. Right. Because if we don't continue on this path for 2 or 3 or 4 years to get the job done, and he loses control of one or both houses at the midterms, then all of this will be for naught. Yeah. And we'll go back to gridlock, which is what this country will do. And that, I think, is our biggest fear in the short term, to be honest with you. And sadly, that's pretty good for gold at this point in time, too.
Yeah, and it always comes back to that for gold. All right, so the clock is ticking. I'm sure we'll talk again soon, and we can review what's going on.
It's a crazy, interesting world right now.
It is very interesting. Well, thank you so much for coming on and trying to make some sense of all of this for us. It was great.
Thank you, Charlotte. It's been great to be with you.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Dana Samuelson with American Gold Exchange.